Ladies and gentlemen, the crypto space, we're live on a Friday, December 2nd at 11:30 a.m. We're on time. That's a good thing. So I want to talk about liquidity. I want to talk about the flow of the liquidity from different one system to another system and back, the available liquidity in a particular system, and how this pertains to the overall sentiment of market actors, of people actually considering to do things, because it is representative of a lot of psychology at play, especially capital flows, but also the total amount of liquidity in a particular system. So we'll pop it over to the main screen. So this is Arthur Hayes' liquidity chart, which is very interesting, particularly because what the Fed does with its balance sheet adds liquidity to the system. What the reverse repo does to the liquidity in the system, it removes it. What the Treasury General Account does to the system is it removes liquidity, or it traps liquidity. It's unspent liquidity, and when it's a potential available liquidity in the system. So this is a way to get a sense of post 2008. This is like the froth in the system. Traditionally, fresh capital, fresh money, the creation of money is done by commercial banks. So that you look at like M2 velocity, but velocity is shot. So in many regards, this is kind of representative of the overall availability of liquidity in the system. Um, it is froth, but how do you get a sense of available liquidity when the M2 chart is literally collapsed? M2 velocity. Well, bear in mind it's up, which is actually interesting. So with total liquidity in the system coming down significantly, let's go back to Arthur's chart. We're down. I have to move over. We're down 15% of artificial federal liquidity. And we bottomed at 20.65, which I've mentioned before is coincidentally pretty much the same bottom we had when everything started to fall apart in 2019. That's aside from the points we're trying to make right now. So this liquidity is somewhat more meaningful than money stock because money stock is significantly depressed, albeit it's up. So this is going to compensate for the decrease of government liquidity or government induced liquidity. So overall, we have a net contraction of available liquidity in the market. When I say the market, I primarily mean the U.S. market. And obviously, the title of the stream talks about emerging markets and trying to understand when we are playing in our preferred market, the crypto space, that is an emerging market, as we've talked about, and capital has to flow from somewhere, has to flow from the market, the U.S. market, into the crypto space for people to do things with. That is DeFi. You want capital to flow into the emerging market, and that's what people use to buy, sell, buy options, trade on DEXs, so on and so forth. So when you see liquidity flowing into the market, there's a general tendency for more activity, increased volume, and speculatively higher price points. There's more capital to actually make purchases. We are in a capital outflow time. Capital is flowing out, and we see that when we look at the total stablecoins. So obviously over the last week, a 1.35% dip in available liquidity in the crypto space is quite meaningful. This is probably the most underestimated macro of this particular emerging market. This is critical. This is probably one of the most important pages in all of crypto, all of DeFi, to get a sense of what the hell is going on. Can prices actually go up? Now, this is a negative sum situation. If this was about, marginal, 0.1%, fraction of a percent, if it was relatively steady, that would be a zero sum game. If you have an increase in liquidity, it's a positive sum. Why do I say this? Because the actors, the people, you and me and everyone else doing anything in the crypto space are literally chasing these stable coins. That's the whole point. The game is scored in dollars. These this is the cash. You're doing what you're doing, buying and selling, or you have your various lock positions, various long-term lock positions that are paying you in cash. This is that cash. So we are chasing a certain quantity of available stablecoins, which is basically, there's chips in the center of the table. 10 people around the poker table. That's all the chips there are. It's not like there's going to be more. It's not unless people bring in fresh cash, in which case now you're chasing more chips, and it's easier to get them because prices are probably elevated, and that's what happens during obviously a bull market that we've all encountered, and we're here to try and understand what kind of market we're in right now, what the directionality of the market is, and it's very obvious, and everyone needs to understand that this chart, as well as that particular metric right there, is indisputably saying it's a negative sum game. The people doing their shit in the crypto space are chasing fewer and fewer dollars. And those dollars, where they're going, yeah, that's part of the equation. Capital, underperforming capital chases outperforming capital. And that's basically entails that capital's leaving the crypto space to chase things like almost 5% return on 1-year bonds. So this is the equation that has changed over the last year. Really started obviously with talks of the QT, not QT. We're never going to do QT. We're probably going to do some QT, but all of that is visually inspected in this chart. When they say all that shit, when they raise interest rates, that decreases liquidity. Raising rates is more complicated, though. That plays into the new capital, because if it's more expensive to take a loan, it encourages people to not take loans, and that suppresses the capital creation process. And then you get into Forex, and you have to consider all the currencies out there, and that's also capital flow to and from different currencies in the Forex markets. And then, interest rates are relative. And so I'm trying to focus what I'm talking on in only a part of the entire complexity of the system. We're neglecting, capital flow between various countries. But what we want to focus on is capital flow to and from the U.S. market and the crypto emerging market, and that gives us at least a way to filter out the noise and not just get totally overwhelmed with the amount of information to digest from a macroeconomic perspective. Anyway, that's my intro. Few people on the stream, 10 people. Thank you all. Quiet day. Obviously, folks are. It's a boring market. There's almost no activity to do, which is something we've talked about, and that's going to continue to be the case. But bear in mind, look, 11 people on the stream, you are the few remaining. When this is all said and done and everything bottoms and liquidity starts to go up, it's only going to be few people. There's only going to be few people that catch bottoms, that are still in the market at the bottom, and participate in the overall net capital expansion that occurs in the crypto space every time systemic liquidity increases. Now, whether that's a long ways off or not is irrelevant, because there always is bottoms, there always is cycles, and these cycles sometimes take years. And I've said it before, the beauty of a locked position is you're guaranteed to see the next cycle. You're going to see it. And I appreciate that. That alleviates the need to have the hodl, the strong hands, and that there's too much temptation to liquidate, a lovely Bitcoin or Ethereum position, because maybe you need the fucking money. And I don't really subscribe to that concept of hodling, because if it can be sold, it will be sold. If you need to buy something, if you need to buy food, if you need to pay rent, you're going to sell your shit. So that's why I appreciate more than ever these permanently locked positions, because they're guaranteed to see the future cycles no matter what. And that's meaningful. That may be one of the biggest financial innovations. A lot of Bitcoin folks are very critical about Ethereum, beacon chain withdrawals not coming yet. It's probably destined, but bear in mind if I would very much appreciate a capacity to allocate Ethereum to a node and never having the capacity to withdraw it. That'd be very interesting as an option. Even if merely for my own sanity to be able to manage that ownership, not a position, it's an ownership, or maybe as a perk, because if you're doing a permanent lock, you are significantly more aligned with the protocol. You are contributing significantly more input to the long-term viability of the ecosystem. So there is better alignment. That's quite interesting. 14 people in the stream. Thank you all for your likes. I appreciate it. Critical Mass, Dan, Kazin, DYOR, good morning. Zoidberg, Sergio, Loki, love your work. Looking forward to your insights. I'm trying to maintain. This is not easy, just like for all of you, and I have to think about these markets and what I'm going to talk about, and I do it for myself, and I like to have these dialogues because obviously, really, this is just a monologue. Done a lot of monologues over the years, and this helps me figure out what the hell we're doing, why we're doing it, and how we could do it the best we can. So that's the deal. Tommy, damn buddy, you need to get some well-deserved rest. Don't let the market get the best of you. Yeah, I'm gonna get away and relax this weekend. Uh, you know, I'm tired. I got two kids. It takes 2.5 hours every morning, 6 a.m. to 8:30. I wake up at 6 a.m. It's all about just getting my girls to school. 2.5 hours. So that's just food for thought. Kids are an immense investment, financial as well as time, effort, and energy. An exercise of patience, but they are the most gorgeous little creatures. I wouldn't have it any other way. George, how are you? Leonardo, we are few, but this is how the bottom of the markets are representative. That's obviously the case. Few will remain because few have allocated to positions that have attributes of survivability, protocols that have that persons have effectively investigated for survivability. I was talking to someone yesterday, and I made reference to outside versus inside. And, you know, it is near impossible to give a crash course on what the hell I talk about. It is near impossible to give an introductory crash course to even how to approach the crypto space. The outside, the people that have never encountered these crypto markets, it is overwhelming. So I guess the point is, if you're inside these markets, it's easier to stay in the market. So the few, you guys on the stream who have stayed, you guys actually listen to me, so you actually have a leg up on the vast majority of the inside participants because look, how many people consume GMX and other options protocols and are actually doing on-chain trading and they get into a situation where they lose and they lose it all and they get disgruntled and they leave the space. But what we talk about on the stream is a very different method of survivability, a very different method of engaging with markets. We, on this stream, have a significantly higher likelihood of remaining in the market because of the way we engage with the market. Now, obviously, I know folks like to dabble, but even if you're dabbling and doing some sort of capital gains play, if the core of your capital management process is how we discuss with long-term protocol alignment, then you will be here for the next cycle, and that's quite interesting. Now, there is absolutely zero way to know what the hell is going to play out. Macroeconomics looks absolutely ready to implode. Credit Suisse looks like it's ready to implode, and that's just a giant Lego piece that a domino that will just start to cascade throughout the entire system. U.S. Residentials looks horrible. New home starts and lumber prices. There's just like it's kind of like all the energy in the system, all the excitement, the desire to take risk and build and expand business and take on loans to grow, to hire. It's like all the energy is gone. And that's understandable. And that's really been the process of the entire past year. That's what a higher interest rate does. It suppresses economic activity because folks don't want to entertain that higher interest rate because what it does to the calculation and the viability of what someone wants to do. Anyway, so that's where we are. We're in a depressed economic environment. You could say relatively depressed, and then we could potentially consider what a depression is like. We're almost certainly heading into a recession because these boys in government will not adjust monetary policy quickly. That'll cause a systemic shock. Obviously, what happened in March of 2020. And whatever they're going to do, they believe they're in control to such a degree that they could do it slowly and gradually. So, which is why I reiterate, this is going to be a freaking boring experience because organic capital creation is just not going to be like, whoa, all of a sudden there's a huge amount of capital because something's happening. So I don't see any significant increase in liquidity on the horizon, which implies a boring ass market. So what happens in a boring ass market? You have more rational capital allocation. You have concentration of capital, which is something I've talked about significantly. And you'll have outperformance. You'll have very isolated outperformance where something that is meaningful, systemically meaningful, infrastructure is identified and defined by the overall market as being systemically significant. And you will have massive rallies. You will have significant outperformance for very isolated components of the market. Um, and that will draw liquidity and value away from other protocols and that's just the nature of a negative sum game. There's only a certain amount of liquidity, so if one particular asset is significantly outperforming, the other components of the system of the market are going to get depressed. People will sell things to buy the thing that's outperforming. Capital flows like with momentum, and the thing that's going up tends to keep going up. OTC derivative numbers out. Curious what your thoughts. I was surprised. BIS OTC. I was actually quite surprised. I thought we were going to see depression. Not depression like the phrase that people talk about, like depression. No, we saw an increase. So this means the banks have taken on more risk. Bank ranked by derivative. So the banks have taken on more risk. JP Morgan has $57 trillion worth of derivatives. Goldman Sachs another 49. That's over 100 trillion just there. And overall, there's net in the system an increase up to $632 trillion of derivatives outstanding. So that's astounding. That means as long as the VIX stays low, as long as bonds start to increase in price point, which is what we're seeing a little bit. The short end isn't necessarily used for collateral. The short end is predominantly used by banks to balance the books against deposits. Oh, I'm on the 30 min. That explains it. U.S. 10-year. Wow, it bounced back up to 4. That's surprising. No, it's not back up to 4. It's down. So price point of bonds on the long end of the curve, which is used as collateral, has been increasing. So that means what happens when your ETH on Aave goes up in value? You can borrow more money. And voila. So that's very interesting. Bear in mind the bond market pretty much collapsed like 20%. So what does it all mean? Because obviously, if collateral significantly decreases in value, it threatens liquidation of the position, and the liquidation of the collateral to make the debt position whole. So I was very surprised. I thought we were going to see a significant decline. There is all the reason in the world for no black swan. Everyone is looking for a black swan everywhere. And there is all the reason in the world for no black swan to occur. And for this to be a boring, depressed, depreciative market with very isolated pockets of outperformance. And there's all the reason in the world for a black swan to occur as well. So that this is how we do the mental analysis of what could potentially occur. And everything that we talk about, everything that I talk about, these markets is applicable to whether there's a black swan or there's just a depressed, boring market for 4 years. And that was what I wanted to do. I wanted to hone in and focus and mature a methodology for engaging with a market that's sustainable under all conditions. I think we've done quite well. Let me catch up. I missed a couple. What else is worth permanent locking other than Curve? There's too much uncertainty in this market to buy a revenue stream that might not be around in 2 to 4 years. Yeah, but it sounds like you're chasing a position. There might not be anything that's good to invest in. I tell everyone, and I'll tell it again, cash is everything. If you're lucky to have cash, you have to be grateful. And if you're lucky to have an income stream that's significantly depreciated, but it's still a meaningful income stream, that's just something to be grateful about. There might be nothing of interest to purchase, or nothing that isn't far out of the risk curve that's a new protocol. A new protocol has no lendiness. There's no traction. There's no trust. Things need to prove themselves over time. So, Joe, there might be nothing, and it's up to you to make that assessment of how much risk you want to take. Will you eventually need the capital? If you need it, you probably shouldn't be investing it. And there's plenty of things that I feel very comfortable in saying will be around in 2 to 4 years, especially the critically immutable. The critically immutable, to me, means everything. That's the way it is. Hilda's in the house. A pleasure. Joe, I like Velodrome. I like that I can receive the NFT emissions through BVelo, but I have to lock because they keep reserved for withdrawals. I was able to take profit last night. Very nice. Velodrome is a fixed version of Solidly. The Solidly launch on Phantom, and to the degree that it was fixed, it's my understanding that the fixes were based on the first version of the Solidity contracts that Andre deployed. Prematurely and horribly, of course, but I'm much more interested in the Solidly mainnet launch, which was released on Arbitrum as a beta test, and I have no activity to do. Don't think about taking positions. You have that. If anything, the history of that protocol, you literally have to give it time to assess if they got it right. It was horrible launch on Phantom that lost a lot of money for a lot of people. So it's just something to be observant of, to inspect, to be interested in, because of the potential meaningfulness of the technology. I mean, if you get the capital inflow and the tokenomics and the emissions are right, all right, you're starting to do due diligence and digest the characteristics and properties and behavior of the protocol, and that's meaningful. So there's literally zero rush in this particular market because there should be zero expectation for anything to significantly appreciate. And bear in mind, with regard to appreciation of a DEX, DAO token, you don't necessarily you're not necessarily interested in appreciation of the DAO token because you don't want to sell it. You literally want the revenue. So what you want is protocol volume. You want to see that liquidity is engaging with the new protocol, that transactions are executing, and that the protocol is cash flow positive. In that regard, does it matter if the price of the token increases? I couldn't sell Curve if I wanted to. I could care less about the price point. What I care about is how much it's returning. 40%. If Liquidity puts up purchases votes, rents votes, and they're paying 30%, and Curve price gets cut in half, to whatever, 32 cents right now. What do you think the APR is? 60%. The APR on Curve, because the revenue is predominantly paid by third parties renting votes. It's a third party source of revenue. The APR annualized is inversely proportional to the CRV price point. So it has nothing to do with the price of Curve. So folks need to inspect the most meaningful characteristics of a protocol, and it's very quantitative. And the best designed protocol creates the federation, which draws in capital, obviously for liquidity purposes, but draws in capital by third party protocols, not humans, protocols that need to purchase and rent. And that capital is what drives meaningful interaction with the DAO. To own voting, to own that part of the system. It's the third party capital that's the most meaningful thing that I've observed in the crypto markets, the emergence of these federations. And as of right now, there's Curve is the leader of the pack. Aura, Balancer, especially with Humpty coming to an agreement to end the war. That's quite meaningful for Aura and Balancer, that things are progressing, things are going to stabilize a bit. I'm quite interested in what plays out there. I have skin in the game with regard to Aura. It's very productive. It pays a lot more than Curve. And I'm interested in what plays out with Velodrome, albeit I'm not, even if it plays out well, I have zero interest in a position, predominantly because it's based on the initial version of Solidity code. So I'm much more interested in Solidly. They already have a pre-federation, or at least the expression that there's going to be a federation on launch, much like the original deployment of the protocol was trying to do. So I think that's quite meaningful, because that's the biggest thing we talk about is damn federation. And if they have it on launch and the tokenomics and the contracts actually work, it could be really big. So anyway, Hilda Camelot? No, I don't want a public sale. I'm not. I'm not. This is not a market to do venture capital. This is a market to be grateful for the dollars that we have, and look for the income. So is what it is. Whereas I missed the 3x on my Stargate after buying the bottom a few months ago, now I'm up like 25% only. Oh, Stargate isn't a revenue producer. Doesn't make any money. So I love the protocol, but I've said quite often that great technology is not necessarily a lucrative investment. Have you bought Aura yet, or CVX? I opted for an Aura position. I did good on my Aura position. I could have done better. Obviously, back here was buck 58, buck 50. I snagged right here at about buck 87. So I guess on occasion I do get timing decently well. Obviously, if we have significant market capitulation, whatever it is, what it is, at least the renting of the votes is inversely proportional, or produces APR, annualized APR, inversely proportional to the price point. But that was my position. If the price is lower, the frustration is that I could have bought more and been able to have more of a revenue stream. If the price is higher, I'm grateful that I bought at this price point. So that's what I opted for. Not CVX. CVX is not a position I have because of what I do with Curve. As far as I know, it took a bit of Aura. That's right, Kazin. Speaking of Aura, did you see the peace treaty with Humpty? Yes, that's a big deal. He carries a lot of weight. He's going to sell a bunch of OTC, which I'd like a position of. But I think that's going to stabilize things meaningfully. Logan, GLP and chill for the next 6 months. GLP carries a meaningful amount of risk. It's not a risk-free position, but it's obviously quite lucrative. Providing capital for people to execute in an options market and perpetual swaps, and the whole gambit of what GMX offers. Obviously it's quite lucrative. exactly, which is odd in comparison to what would be expected in this environment. Now, why would they risk on now? There's no chance, digital nomad, of anyone going significantly risk on now. Risk on, you will see risk on mode here on DeFi Llama. Risk on mode is when capital starts flowing into the system. When you start seeing 3%, 5% increases in stablecoins, 10%, that means there's capital flowing in. You got to remember, when I call this an emerging market, I'm talking about literally comparing it to Spain, to Brazil, to Argentina. This is a country, not a physical people, not of a central bank, not of a landmass, but clearly this is an emerging market where capital, dollar denominated capital, is trapped. There are relatively there are representative dollars by USDC and BUSD, which are backed by actual dollar deposits. So it is $1 in the closest form that you're going to get. There's the euro dollars, which are collateralized debt positions, Tether, DAI, Frax. Pax is a back dollar, but so on and so forth. USD is a back dollar with a dollar deposit. But the point is, if you want to see when risk on is the sentiment at hand, it's when capital is flowing in. When capital is flowing in, if you start seeing $1 billion a week of capital flow in, what are they going to do with $1 billion? They're bringing the money in so they could use it. They could buy stuff and stake it and lock it and do things with it. That's risk on. This is not risk on. And this is why I said this is probably one of the most important pages to get a sense of what the heck is going on in the market. A negative sum game is what's going on, minus 1.35%. Robert, you're a fan of Marvel? Yeah, I got a nice Marvel poster in the background over here. Old one. I got this when I was a kid back in the 80s. Yeah, what just Willow's cool. Well, it's cool over on Disney. I like that. You know what's cool? Tulsa King on Paramount. Holy crap, that's wild show. That's really fun to watch. But the Marvel stuff, I mean, literally, does Marvel make a bad movie? Seriously, seriously, I'm digressing. But the 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 um, the the nuance and the subtlety to Marvel compared to like DC, there's a certain spark to the plot, the story, the execution, and the production of a Marvel movie that just has no comparison. It just flows and has a certain feeling to it that just cannot be captured, especially by DC and definitely not anyone else thus far. Anyway, my man Robert. Joe, well said, Cap. I'm renewing my 4-year Spirit lock. Now, bear in mind, yeah, that's just a disappointment. I had a meaningful sized position on Spirit as well at the height of the bull market, but there's death of protocols. Even though it's a lock, there's no guarantee, like you said, what the hell happens. So Spirit is, who knows? Maybe it reinflates, maybe volume picks up on Phantom, but Phantom, the liquidity is drained. But bear in mind, I have a little bit as well. I'll probably relock it, but more or less, I'm just like, all right, whoopie do it. I just don't really do anything with it because the liquidity on Phantom is dead. It's relatively dead, and Avalanche is better and Polygon is better, but bottom line is capital flows from an underperforming market to an outperforming market. So if liquidity is draining from Phantom, Avalanche, and Polygon, and the liquidity is draining from Ethereum mainnet, it's just everything's boring. But where's the biggest market? The biggest emerging market of the crypto space is Ethereum mainnet. And so that's where my interest is. I'm interested in markets that are outperforming relatively in this net underperforming environment. Capital's flowing out of crypto into other shit. Look forward to capital flowing back in. That'd be nice. Stargate does produce revenue now. What? Where does Stargate produce revenue? You could claim stables by staking STG? Hey. Hey, hey, hey. What are you talking about here? Where could you claim stables? I don't know about that. You can claim stables by staking. Oh, oh, oh! Yay! I just found $772. Okay, okay, Joe. Thank you. You made my day. But apparently, my what I got from my Vesta with the auction is not included in the staking fees. But I have on this mainnet is from special event auction. This is when they first released, but apparently it's not part of the staking fees. But okay, Joe, thank you. I, now I could go to take my family to an all-you-can-eat Japanese buffet. Woo. Well, that's nice. Very nice. Hilda, where do you vote with VECRV? Well, you go over to here to votemarket.stakedow.org, and the only meaningful places to allocate capital to is the Stakedow vote market, which are right here, which is just like original vote.bribe.crv.finance. You know, if you go to vote, it takes you to Curve. And just pick one of these. They're more or less the same, but it's nice. So Dola looks like it has the last week. Curve's paying. Obviously, potential revenue is drying up, and it is what it is. Um, so the Warden is tapped out. It's full, and I wish I understood what's going on with Liquidity, because if Liquidity doesn't have a, um, a vote rental, if they're not renting votes, how the hell are they driving capital for the chicken bond? So I don't understand what's going on there. But both of these are sold out. 0%, 0%, 25%, and 30%. I have my position in WFT, but I over allocated due to some UI things. So I'm going to migrate some vote weight, probably over to like a CRVF. I'll go to the lower percentage. Um, so this is where your capital is. Vote market. That's stakedown.org. It shows you everything. Shows you StakeNet. So StakeDAO shows you Warden. So it'll show you the Warden. It'll show you Vodium. Just doesn't have anything. And then you got this is deprecated. This is the contract that's manipulative or manipulable. And it shows you Y-Bribe, which is Yearn's new contract. So MIM still uses Yearn's new contract, and it is what it is. At least there's 9% on the money available there. That's the deal. Did you see Flywheel podcast with Sam? They're going to start bribing Aura too. Yeah, I heard about that. Well, you guys know my opinion of Frax. I think they make a significant amount of revenue. They spend it. They're part of the flywheels of all these protocols. And if they start digging into Aura, I'm happy. I have my position in Aura is nothing like the size of the Curve position. But interestingly enough, the Aura position produces almost as much weekly revenue as the Curve position. So it was a nice addition. Now, I have been thinking about, was it Vote Locked CRV from Yearn? I don't even know what the website is, but the Yearn's YCRV, I think it's VL YCRV. Um, I'm interested because they're just doing all of it. It's like an ETF, and they manage the all the transactions. And it's about 70% of the money, but that's basically what we get. We get all of that between curve transaction volume as well as the bribe. But they're compounding, and obviously the 72 is a compounded APY versus an APR. So I don't know. I was looking at that. Um, Hilda, do you need to update vote when? Yes, every time you lock me RVR ECRV, I'm pretty sure you do need to re-vote. I was talking mostly about the OTC numbers. Why risk on now? I also expected depreciation. We got a 32 trill increase. Yeah, that's a good question. I have no idea. Um, there's the narrative out there in macro land that we're not going to go into a bear market. There's going to be no recession because everyone expects federal intervention, or maybe something about macroeconomics is not understood, why it is different this time and things are just boring. And if everything was just stable and the VIX was low and there wasn't some sort of volatility explosion inbound, in order for banks and pension funds to juice their returns so they could satisfy their obligations, they need to increase their leverage. So, in a completely stable situation where no black swan is expected, all right, it makes sense that derivatives are through the roof. How else are you going to generate the returns that are needed to pay your pensioners? Um, but clearly, they're risk on. And they're taking big risk potentially with pension systems. Look, England blew up. They were bailed out by the Bank of England. The collateral value fell to the point where they were going to get liquidated. That's crazy, and that's what we're dealing with. So there's a significant amount of systemic risk. There's all the reason in the world for black swan event. There's all the reason in the world also for somehow things to actually remain relatively calm. Is what it is. Hope that helps. It's a good thought though, digital. Robert, I asked because of the reality that stone called Aether and how eerily similar they described its purpose and how it's related to Ethereum. Yeah, yeah. Well, it is what it is. There's a lot of tech. Some of it could fail. Some of it could be successful in the end. That's why I say what I say. It's all about dollars. This game is scored in dollars. So either you have a capacity to walk into a store and swipe a debit card to pay from a bank account or to pay with USDC. None of this matters. So the biggest learning lesson, I said it a phrase during the stream, outside versus inside. The outside people, what the hell are they doing inside? But in the inside, I've talked extensively about the first thing an outside person probably should do is figure out how to operate and spend money, spend crypto money, spend USDC using a debit card, and then it all makes sense. So that's that's what survives. That those are the systems that survive because they have meaning. They have systemic meaning. And 69XXX site, thank you very much for joining. We're not that type of stream, are we, boys and girls? Hilda, you're very welcome as always. It's a pleasure. Rupert, what's up? What's up, Rupert? In the house, digital. You're very welcome as always. All right, we'll wrap up the stream. Let's look at Curve. Curve hanging on the 64 cents. That's good to see. Let's zoom out to the monthly. Very interesting monthly with the massive liquidation wick when the manipulative short position was liquidated. Wild to see. There's a lot of ways to interpret this. You could say it's significantly depreciated from all-time high, or you could say it technically never printed a new all-time low, considering a malicious attack, a financial attack of $100 million on chain, and it never printed an all-time low. And there's a couple of different ways to interpret this. I interpret it as relatively stable, and it's hanging on. Why? Because it has an attribute of survivability, and that's meaningful. Let's look at the DXY. So a good part of the market has been not just capitulating down, down, and down. It's because the dollar has finally been retracing. We were at like 510, 515 today. This is the weekly. Let's go over to the daily and we can see the whole candle. Yeah, we were up at buck 0560 and we're down at 104.60. It's literally down one. That's a lot. And bear in mind from a technical perspective, we're below the 200 SMA, which means and it was rejected. So it was a 200 SMA breach with a retest on the daily. So that's interesting. So that means we're probably heading towards the 103 region. So there could be some more liquidity because this is basically global liquidity. When the DXY goes down, there's more liquidity available in non-US dollar currencies, which is quite interesting. And if we go over to the S&P, wow, Dollar down, stocks up. This is on the daily. If we close a Friday with a hammer like this above the 200 SMA, it's quite interesting. You know, the last time we were here is April, and it fell right back through in a couple of days. Next week compared to a very different time compared to April, but next week we have a capacity to inspect technically if it's different than April. So right now, I'm very interested in 5 hours from now if it closes above the 200 SMA, because already it's an expression of support. It bounced right off the TWAP and it's closing above the 200 SMA. If it closes above the 200 SMA as an expression of support, and then we start Monday, Tuesday, dare we print the higher high, because you guys know the deal. The trifecta of bullish confluence is the breakout, the retest. I'll grab the pen. The breakout, the retest, and then the higher high. That's the trifecta of bullish confluence. So that'll be very interesting to see. And this is coming next week. This isn't like, what's going to happen in a month. This is next week. This is the daily chart. Monday, Tuesday, Wednesday is going to be very interesting from a technical perspective, how those candles print. James, Curve USD, any downside looks so promising. So that's another story about Curve. We'll end on the Curve USD thought, and I obviously am deeply invested in Curve, and the price point is depressed. Bribes are drying up. Protocol volume is still there. It's not the most lucrative. It's a couple percent up. I've seen we've seen some big numbers at times, but it's mostly not a lot. But there's the narrative, James. Well said. Coming in with the last comment, talking about probably a very meaningful narrative for Curve. That would drive potentially a large amount of revenue for the CRV holders, and obviously all the liquid derivatives. But the liquid derivatives are a step away, and I just want to own the base layer. I don't want all this complex shit. You know why? Because you could sell it. You could sell SDCRV. You could sell YCRV. You could sell it. And I don't want to own something I could sell. Because then I'm tempted to sell it. And I'm worried and I'm thinking, should I buy? Should I sell? And I don't want any of that. If I have an extra couple bucks, I'm going to buy something. That's it. It's a purchase. If you don't have any extra money, don't buy it. Keep the cash, save the cash, be grateful that you have the cash, because that's the negative sum game, and that's the market we're in. This market is malicious. It's predatorial. They will take it. Protect your cash. And we'll have our time when it's up only. Friday, December 2nd, 12:17 p.m. I thank you all for joining me. I wish you all a wonderful weekend. It's tough times, but we'll get through it together, and we will see the next market. You know the deal. After party on Discord for the most rational community in the entire crypto space. I appreciate all of you in there, and I'll see you later today. Peace.